The world as we know it is changing at an unprecedented pace. Driven by rapid advancements in artificial intelligence and technology, we may be careening towards an economic reality that shatters our current understanding. This is the perspective of Raoul Pal, a former hedge fund manager and co-founder of Real Vision. In a fascinating and wide-ranging discussion, Pal paints a picture of an economic singularity on the horizon, a point where our traditional economic models and assumptions completely break down. Buckle up, this video is going to challenge your assumptions about the future of economics, work, and human productivity as we know it. I'd greatly appreciate it if you could spare a moment to like this video and subscribe to the channel. Thanks. Enjoy the video.
AI is infinite human knowledge, and it's going to get cheaper and cheaper and cheaper until it's water. So you scale knowledge at zero cost, which is the human brain, and above that, because that's where we're going. And then you've got the robots, which scales physical humans. So now we have infinite humans at an exponentially decreasing cost. What the fuck does that mean to GDP? Next, productivity. Productivity is basically the output per kilojoule of energy. If I look at UK electricity prices in the last 50 years, they're pretty stable. Sure, they're cyclical, but they're pretty stable. So with EV technologies, geothermal, wind, all of the stuff that we're working on, we know that they don't scale enough yet, storage problems, other stuff, but we know they're going exponentially lower in price and they're rising in output. And then we've got nuclear and what we can do with nuclear technology. So we are going to halve, and maybe halve again, the cost of electricity in the next 10, 15 years. What is that going to do? Well, think of productivity. If technology goes down half, productivity's doubled. If it goes down half again, productivity's tripled. So you're going to triple productivity while introducing infinite population. Right, so I get to a problem that I get to 2030. My job has always been to live in the future, and I can't see what this is. This to me is an economic singularity, where maybe all understanding of economies and economics completely breaks down. Now, I may not be right, it may not be 2030, maybe 2035, maybe 2020, I don't care. The point being is we are fast approaching this point. Okay, also we've got to understand that as AGI comes, and I think OpenAI have got AGI, I think they are using it to build their business and their models and their everything, which is why 500 people can out-iterate everybody on Earth. Now, when everybody gets this, the speed of disruption is going to be like the meme coin cycle or the ICO cycle. What business lasts? Who gets disrupted by whom? How long do these disruptive cycles last? They could be hours, they could be days, they could be months, maybe a few years. We just don't know. What does it mean once we've got AGI? What does it mean for markets? Once we've got something that can pretty much process all of the data and all the understanding of markets and make investment decisions. What, is one person going to figure this out and become the richest person that ever lived? Or do they... people aren't thinking this stuff through. They keep talking about, well, it's going to replace jobs. They're missing the bigger picture. This is beyond our understanding of anything that we do. Okay, and it's wildly exciting and terrifying. We both agree. So what I'm suggesting is you have 6 years to make as much money as you can, because you have no understanding what the world is going to look like. And luckily, we've been given the gift of an opportunity, which is we can invest in technology, more so we can invest in crypto. But beyond that, what is an asset management business? What is this conversation? I'm already developing an AI that's my avatar that can speak. Well, in 3 years, I'm just going to put my avatar here speaking to yours. I won't even be here. I think people are scarred, and so they keep this treasury as opposed to reinvesting it because people are so scared of the capital cycle. But this is to my point. The capital cycles are ferocious in crypto. They're quick. You can make a lot of capital. Then there's no capital. Then there's capital again. Businesses this is real-time VC, so businesses fail, businesses grow, businesses stall out. It's all there in real time, played out in the drama of Twitter. And that's what it is. And people have to get used to that. And I think the world is going to look more like that, not less like that.
Hal draws parallels between the current situation and the 1950s, a period marked by high inflation and economic restructuring following World War II. During that time, governments resorted to financial repression and yield curve control to manage debt levels while allowing productivity growth to outpace inflationary pressures. He suggests that a similar approach may be necessary in the coming years, with central banks potentially employing unconventional monetary policies to navigate the economic disruptions brought about by AI and technological advancements. Another significant aspect of Pal's discussion revolves around the impact of AI on financial markets and investment decision-making. He speculates that firms like OpenAI may have already achieved artificial general intelligence, AGI, and are using it to accelerate their business processes, giving them a significant competitive advantage. As AGI becomes more widely available, Pal envisions a world where market disruptions occur at an unprecedented pace, with businesses rising and falling in a matter of hours or days.
So if we look back after 2008, we didn't have one except COVID. We should have got one potentially in 2015 after the massive dollar rally, but we almost were certain to have had one in 2019, but the forward-looking indicators were picking up. As they are now, we haven't had a recession, but yet the forward-looking indicators are screaming higher. Is something different now, or is the use of the central bank balance sheet and liquidity changing the game too? I.e. the debt cycle doesn't ever really kick in because we don't allow it to. So I went back and looked at, there's one period of time that's actually very similar to this. It's the 1950s. People, it makes me laugh, the same inflation chart that they put on Twitter every time about the 1970s. Actually, it's the 1950s, so obvious. I think we even talked about this on the spaces we did a while ago. It's like the 1950s, everybody was in the military or kind of basically locked at home working in factories, whatever. They all come out, they all want to buy shit. The factories aren't ready for shit to be bought, and prices go up, right? Inflation went up to 20%, and then it came down. And it came down to negative. And then it kind of had the rebound for a bit. But what happened was all of these economies were saddled with massive debts, as we have been from the aging population, and that was from war that time. So what they did was financial repression. They did yield curve control. We're using the balance sheet. We might go to yield curve control. So you have financial repression, and then you basically wait for productivity growth to increase over time. So there was a lot of investment in future technology. You think of the 50s. But that period, the stock market was exactly cyclical like now. Most of the debts had all been restructured in this 4 or 5 year time horizon. So we saw this perfect cycle that I call the everything code that we're running now. It was identical. The market screamed higher, bear market. Scream higher, bear market, like clockwork, like this has been. Same as the crypto market. It's like, we've seen this before. It was the same problem, same outcome. And that time we got out of it from population growth and productivity growth. This time we're going to get out of it from population growth, but infinite, and productivity growth. So it's fascinating. CPI and wages, they just don't really rise. I mean, I was stupid enough to start an agricultural hedge fund back in 2007, thinking, hey, there's a new secular bull market. There's too many people. We're going to have to use all. I'm a moron. Productivity just crushes it, right? And productivity and technology crushes prices over time. So our wages don't go up, and there's too many people. And then we have to compete in the WTO with China and everybody else. But because of the mechanism we talked about, the savings, as people get older, their savings go into the markets, and then debasement of currency. So you've got this bifurcation of what I'm spending my day-to-day wages on, and assets. So assets are future deferred consumption. You buy an asset today, so you can sell it in future to buy something with it, right? Future deferred consumption. And you want it to be worth more than it was today if you get it right, or at least the same in equivalent terms. But the problem is they're going up, so you can buy less of them. So if you look at how much of a house you could buy 30 years ago versus today, it's like a third. And so that issue, that's why people don't understand inflation. They get all mixed up around these topics. It's like there's different types of inflation for different types of things. The affordability of assets is a massive problem. It's an even bigger problem if CPI inflation is low. I'm a big proponent of the welfare state, but it's very expensive to run, and governments run businesses badly, right? So it always goes awry. But it does help because you've got some sort of safety net. In the US, you don't, so you become a bigger risk taker. US by culture is a risk-taking country. So there's different ways of skinning the cat, as it were. But we have basically taught anybody in the financial world that you shouldn't do it yourself.
Whether you agree with Pal's specific predictions or not, one thing is clear: the confluence of AI, robotics, and technological progress is ushering in a new economic era. Maintaining an open and adaptive mindset will be key to thriving in this rapidly evolving landscape. As always, let me know your thoughts in the comments below. If you found this content informative, don't forget to hit that like button and subscribe to the channel for more exciting videos. Thanks for watching, and I'll catch you in the next one.